Good morning. This is London. We're going to go through a volatility review so you understand today what is volatility, the pressure between the buyers and the sellers. We're going to discuss how to capture volatility, how to look at it, and what it means to you. If you like crypto, and good morning to all of our VIP, America and International number one trade group. This is London, former hedge fund owner, private, non SEC, not financial advice. As we look into your desire to trade volatility. A lot of you are attracted to crypto, maybe some Forex or certain stocks that are highly volatile. I'm going to go through some pattern recognition in terms of volatility, not standard pattern recognition, but volatility patterns, repeat cycles within volatility, and I'm going to show you how to capture, okay, and visualize opportunities in the market. I want to remind you, former hedge fund owner, private, non-SEC, not financial advice. Go to your broker if you want that. We trade. In terms of the details, let's look right now at the chart. Let me reload this chart on the left-hand side. The left-hand side, it's going to be your right-hand side. The top right, we just caught this move in the back. We'll discuss actual patterns to trade. What I'm more interested in, if you look underneath the actual patterns, and let me actually go to a specific chart on the bottom right so that you're not excluded from, let's say, the DXY or the Bitcoin chart, what we're focused on here. Okay, if you ever get trapped I'd say your trading view, you can always go to products and go to chart, and then boom, there you go. Go to products, then chart. It will open back up your chart feature. Now, as we're going to talk about, and this is really a secondary video that we touched on last week, but I want to discuss again. Now, volatility, and good morning to the VIP. Hope you're all doing well. Absolutely exciting right now. We just caught this move in the back. Now, most people think of patterns, a pattern recognition. Okay, I understand you might say, what an ascending triangle is. An ascending triangle. What's the important part about an ascending triangle? Two features: flat top resistance, right? The buyers have come in at a preceding pivot and decided to take, boom, at a preceding level of resistance, that which is holding back price. Yes, so when you look at the flat top resistance and the ascending line of support, two features for the ascending triangle. Okay, ascending line of support. We look for these flat tops in the market. Now, that's a standard traditional pattern. That's a pattern that we would look at and say, we want to trade that pattern without a doubt. And we did in the back. Good morning to the VIP. When I say that I want you to help you recognize volatility patterns, okay, I'm not talking about an ascending triangle. Okay, although volatility is built into an ascending triangle, or it's built into a bull flag, okay, I want to discuss today with you how you can essentially look at a volatility gauge. And I'm going to reference our Z-Pack, which our VIP are using. And what is it? If you're looking at RSI, if you're looking at stochastics, if you're looking at MACD, and if you're looking at Bollinger Band, let's say you have all four of these indicators all spread out on different screens and time frames, and flipping through and trying to find what is the most appropriate time frame, what is the most appropriate. Let's find a good view there for you guys. This is our setup so that you know the level of diagnostics that we do. But as you are looking at the specific RSI, MACD, stochastics, and Bollinger Band, trying to wrap your mind around all the strategies of all of those, our Z-Pack includes the elements of those indicators and synthesizes them for you. Now, as we were to look at the move in the back, I'm going to assume that you participated. If you were in our VIP, brought this to you in the back. In terms of the carry up feature, bam, nice carry up feature. Very, very run of the mill, very, very normalized trading here, very predictable. We love to see that level of conformance technically. Now, that's with a standardized pattern. Let's take a look at instead. And we have Scotland in the house. Good morning. We'll say Scotland, good morning. Nice to see you, Scotland international team here. And Venus, absolute pleasure, without a doubt, to have you here this morning. As always, it's an honor to be building with you in 2023. Wouldn't have it any other way. Exciting to be covering volatility this morning. As you see volatility come into the mix, You may want to pay attention if you watch the preceding video, especially now because I want to cover this again as our traders are looking at volatility expressed by the specific standard deviation. We're going to talk about standard deviation again here just a moment. What is a standard deviation? We're going to talk about this so that you don't have to ever compute it. So that you don't have to ever compute standard deviation. Something that's pegged at 1, all right? Something that's pegged at 1 and has no volatility. What's the standard deviation? There is no deviation. There is no volatility. It's pegged at 1, right? Something that goes from let's say 1 to 50 cents up to zero point 0.5. Let's say 0.5. 1 to 0.5 to 1.5 would have a calculated level of standard deviation away from 1, right? Something that would go from 1 to zero point 0.1 up to 10. Wow, now that's some more volatility. You understand? From the example, the first example, something that's pegged at 1, right? And it never changes. Is there a standard deviation? What are we going to measure? There's no deviation. There is no adjustment to the moving average. Now, our tool here is going to have on the right-hand side, you will have moving average. Please pay attention to that, moving average. Okay? Now, as you see on our specific, and let's just recover those, review. That would be the first example, 0 volatility. It's pegged at 1. A little bit more volatility, something that starts at 1, goes to 0.5, then 1.5. Hey, I like that. We could maybe trade that. It goes from 0.5 to 1.5. A good trader is going to say continually, like all the time. It's going to repeat cyclically all the time. I can buy at 0.5 and sell at 1.5. I'm in. Count me in, right? Okay, so a little bit of volatility. Yes, it's hitting a standard deviation around what would be the average. In a simple example, the average would still be 1. Now, if we were looking at more volatility, what if something was 1 and it went down to 0.1 and then up to 10? Now we're talking. Now we have more volatility. Something's going from 1 to 10. It's going from 1 to 0.1. Starts to sound a little bit like Bitcoin, right? We trade Bitcoin. Good morning, guys. I do make sure in the mornings, just for the record, we stream the open. We stream the Open of New York, and this is a side feature, so you get to know us a little bit more. We stream the Open of New York, and I continually let Bloomberg have it, and I continually listen to them, and I just try and see if there's anything really, really pertinent that, well, maybe I should not talk right now over Bloomberg. Most of the times I say I should have just streamed the Open. So we'll start doing that. I don't want to leave those guys out. They have a big point of recognition. But as we stream crypto and talk about some of the finer points of day trading, we welcome you and we're excited about your journey in 2023. Now, you have the example. Example 1, no volatility. It's stuck at 1. I can't trade this thing. It's stuck at 1, right? Almost use it as a store of value if required, right? Then you have the second example. You have the second example where you're at 1, it goes to 0.5 and 1.5. Nice. And you can visualize that. Think of a dollar. And think of 50 cents up to $1.50. It's a little bit of volatility. Not bad. But then you get to the third example, and think of the standard deviation. You would have a cycle in terms of the measurement of 0.5. Okay, 0.5, 1.5, 0.5, 1.5, 0.5, 1.5. What's in the middle? The 1. Okay. Now, on this example, I don't want to get too complicated mathematically, but just to let you understand, and I didn't have to start at 1 for purposes of that disclaimer. Okay, we could change the example and not start at 1, but let's get into the third example just to reinforce again volatility. Okay, if we have 1 and we're going to 0.1, man, awesome. All right. And we're going from 1, and in the same example, it's going to 10. Ooh, nice. Those attract people. You understand that. You'll see an altcoin or a stock that's the highlight of the day. It hasn't done this in 10 years. Everyone all of a sudden wants to get in and trade it, right? That green on the screen could be compelling, right? As you look at the volatility, okay, I want you to think about example 1, 0 grade volatility. Example 2, medium grade volatility. Example 3, high grade volatility. Now, how would you if you were to look into, let's just make sure we have the right, let's say the right, I want to make sure that we have the best angle for today. I think that's fine. It's okay. As we were to look at, I may move the camera just slightly so you have a better view of the complete setup here on the left of what I'm looking at. Now, one of the best ways for you to look at the average, because there's so many different averages, let's cover that. I'm just telling you, in day trading, as we're seeing a throwback on that pattern. Just to review very quickly to talk about a standardized pattern, then we'll get into the moving average issue. But as you would look at a flat top resistance, ascending line of support, that ascending triangulation, what is this move? I mean, the traders who don't know that they don't know would look at this move on Bitcoin and just say, man, that completely failed. This ascending triangle, we were hoping it would go up. And it did go up to its exact amplitude measurement, bam, to the upside. And then it threw back to the prior level of resistance. This is a classic feature, the throwback feature, back down to the level of resistance to test it as support. Become familiar with the throw back. Become familiar with the notion that you will have an entry and often an exit on a trade, and there at target potentially another trade, a potential short. A long to get to target, a short for a possible throwback. A lot of factors and complications need to be brought into the foray when you are looking at participating at that advanced level. Let's get back, and I'm trying to stay current with the technicals so that we can also incorporate in your day trading strategies and a little bit of learning and comprehension as we're developing these issues. Looking at our specific, and I want everyone to understand what you're trading when you trade our Z-Pack. This is the volatility gauge you've been looking for, if you know what you're looking at, okay? Because it encapsulates RSI, buying and selling between the bulls and the bears. It encapsulates stochastics, which is a derivative. Guys, I've done the math behind it. It encapsulates RSI. It encapsulates the stochastics. It encapsulates momentum, MACD. It encapsulates all of these features wrapped around a Bollinger Band start, just a Bollinger Band start. I'm not going to limit it to or necessarily even limit it to a Bollinger Band because I know I've been there in your shoes and you hear Bollinger Band and it's that page in the book that didn't attract you. It is that chapter in the workbook that you decided to skip, right? Bollinger Band. It's just the other guy wants to talk about this and you would say, I have my own way. Right? I understand resistance to something you're not using. I get it. All right. I've been in your shoes many years ago, probably in high school. Okay. Started really focusing on advanced TA in high school. Don't know about you guys. That was normal for me. Nobody else in high school, though. I was the only guy. Everybody was, reading their Macbeth or something, and I read it like 2 weeks in advance so I could sit there in English class and read my New York Institute of Finance, where pro traders go to school. True story, Macbeth. Everyone's reading Macbeth. I read it 2 weeks in advance so I could sit in English class and actually go through and read the New York Institute of Finance. And I got the English award somehow. And it was just funny because I actually read it 2 weeks in advance. So it was all easy for me. It's like they're still on they're still on that part of Macbeth. Like, they'll get there, and I'm sitting there reading New York Institute of Finance just to tell you, okay. And good morning. Hope you guys a little bit of humor, attempt at humor. Do your homework early. Get your kids to do their homework early. Huh? Maybe New York Institute of Finance can help them through high school. Now, what we're looking at is, if I were to clean up the chart here, and this is going to be a great video. Let's take a look at this. If I were to clean up the chart here, let's look at only the Bollinger Band is nothing more than a moving average. Let's look at a moving average. And what is a moving average? Well, we're going to define a period of time. Let's say the last 20 sessions. I want to know, let's say on the last 20 sessions, I want to know what is the average, okay, what's the average, as you would look at this, what's the average over the last 20 sessions of price? That's it. What's the average of the last 20 sessions over price? That's that red and green line. That's it. It's the 20 moving average. Very easy. But you don't conceptualize it necessarily. You don't think about calculating it. You don't have to, right? We certainly have that in the mix. And as you were to look at your moving average on our volatility gauge, I need you to understand that the 20 moving average, we have picked the 20. I'm going to tell you why, because it's standardized. You don't have to say, well, that's not what I use. I use the 4, the 9, the 18, the 21, the 5, the 7, and the 11, aside from the 100 and the 200. Whatever your moving average is, okay, or the 33 or the 76, whatever it may be, we picked the 20. And if you're that advanced in terms of your moving averages, you will agree the 20 is a normalized, standardized moving average. Yes, you will. Okay. And if you aren't at that level and you're still predisposed to only using your moving averages, you need to do a little more homework. And it's okay. Do a little bit more homework and find out how the 20 is relevant. You'll find it. You may have to go back to some of the chapters in your TA that you decided not to read that chapter. That part in the workbook, I don't want to focus on that part of the workbook. All right. And it's not all your fault, just so that you know, when you're dealing with technical analysis and you're becoming familiar with different components of TA, understand your aversions to certain elements of TA have nothing to do with you. Don't take it as a personal defect. You will pick up a TA book. I promise you, you'll pick up a TA book along the way, and you will find an awfully written chapter on Bollinger or 20 moving average, or it could be Fibonacci's, or you will find a horribly constructed presentation of the material for you to master. All right, for you to get in and really, really, put your horns into and really conquer. So when you're averse to something, do recognize in the course of your journey that you may, highly relevant here, that you may have had a poor level of exposure to it. You may have had someone who had no business publishing something on, let's say, the importance of a 20 moving average. You may have read it first in a book where it was just presented awfully. The grammar wasn't correct, the charts were off, it didn't make any sense, or maybe you found an illegitimate guide somehow on the internet, or this guy was using it, or that girl was using it. Understand, that doesn't necessarily affect the utility of it. So have a bit of an open mind as you look for those sources and you refine and synthesize the information and apply it. Okay, so with those elements considered as to how you may be prejudiced against or for information, very important as we look into the 20 moving average, just the 20. We're going to throw the 20 on, and I want to talk about the volatility. Remember our 3 examples? What were they? 1, something pegged at 1. Let's say example A, something pegged at 1. That's the first example, no volatility. The second, B, example is 1, and it goes between 0.5 and 1.5. You start to think, hey, maybe I want to trade that. Yeah, from 0.5 to 1.5, it's got some volatility, huh? The more standardized, right, and normalized that volatility were, the better it would be to trade that, right? And hopefully rapidly, right? We want the frequency of trades to be, you got it, right? We want a rapid normalization of the volatility with entries and exits, right? Unless you're shorting, entries and exits, right? Or both. Entry and exit, entry and exit, entry and exit, entry and exit, entry and exit. Now you got it, right? And we want that frequency. Boom, 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 more trades, right? So that's example number 2. Is the dollar, or let's just say the 1 down to 0.5 and up to 1.5. Okay, now, as we were to look at the third example, and we have some volatility in that second example, that B, right, that we are capturing, that we're excited about. The third example, increased volatility. We're going from 1 to 0.1, and we're going from 0.1 back to 1 and up to 10. Back to 1, 0.1, back up to 1, and up to 10. 1.1, you start to see that we have more to trade, more volatility. Start to think, well, especially, man, you start to do the math real quickly. Hold on. You're going to go from 0.1 to 1. That would be 10 times your money. Hold on. That would be 10 times your money. And then you're going to go, again, you're going to go from the 1 to 10. That's another 10 times your money. Hold on. So on the 1 to 0.1 to 10, there's capturable within there 100 times your money. Yes. So the third example of volatility becomes highly relevant in crypto. Okay? And maybe some of your ICOs or pre-ICOs or whatever you're looking at in terms of your trade opportunities. Yeah? Sinks in. Pegged at 1, no volatility. Mid-range B option is 0.5, and now you're 0.5 to 1 to 1.5. Okay, so you got a triple in there, right? The 0.5 doubles and then triples from 0.5 to 1 to 1.5 in the mid-range. Then we have the third example, the 1 down to 0.1 to 1, a 10x, another 10x of that up to the 10. Okay, so two 10x's, we've got 100x in that equation. Yeah, bravo. So when we're looking at capturing volatility, we want to participate in the third example. Ideally, what's still relevant? What's still relevant is that frequency that we talk about, the frequency with which, if the second example goes from let's say 0.5 to 1 to 1.5, and we get this volatility and we really get it cooking and bam, 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 we're able to trade this every few minutes, anytime we want to. Compare that, and the frequency is there for the trades. Compare that second example, example B on the volatility gauge, to the third example, the 100x. And it only does that, maybe it does that every few years, right? And it's a little bit riskier because it could go from 0.1 to 0, right? So there are some different considerations as we look at volatility. But endeavoring to stick in with our example and look at that 20 moving average, let the 100x wake you up just a little bit on the example versus the 3x, let it wake you up a little bit on the example. All right, and the frequency with which we're going to evaluate the 100x volatility level with the 3x volatility example versus your decision at any time as a trader, investor, otherwise, and you tell me, not financial advice, but that one, right? What's the fallout syndrome on that 3x? Sounds too good to be true. What's the fallout syndrome on the 100x? Sounds too good to be true. I like the one. Yeah, some people will like the one example on volatility, depending upon the risk profile. You gotcha. Now, looking at our volatility gauge, what we have on the top screen is a 20 moving average. We have a 20 moving average. Okay, we've got Bitcoin underneath here just to keep in line with what we're looking at. The 20 moving average is surrounded by two blue lines. All right, now call this quickly, just call it a standard deviation. A standard deviation. Okay, it's a calculation. On example 1, okay, on example 1 that we have, standard deviation of 1 pegged at 1 that never moves is, guys, is incalculable. There's nothing. There's no deviation. It's literally the average is 1, it is 1, it will be 1. As we start to deal with issues such as frequency, I don't necessarily want to get into the issues of, let's say, frequency, the rapidity with which you can actually trade between example 2 and 3, the 0.51 to 1.5, okay, versus the 0.1, okay, to the 1 to the 10, bam, bam, bam. Depending upon how quickly, this is very, very complicated if you want it to be, or just let's get through this little 5 to 10 second comment and we're going to get into exactly what you need to know. Depending upon the rapidity, the pace, okay, with which the second and third example decide to operate, okay, decide to get from the 0.5 to the 1 to the 1.5, okay, you may have a nice level of comparative standard deviation to the 0.1 to the 1 to the 1.5. You could relegate. You could strap down and confine the move of the third example to where it is so slowly, so slowly, so slowly, so slowly going down that the average would adjust of it, and the time frame could become relevant a bit more, but the frequency with which you're moving, unless you're tied into that one over a period of time, I'll just tell you, you can slow down the third example, and it becomes relevant in terms of what you would say that the calculative. You'll understand that concept cleanly when we look at our volatility right now. Look at it and put that on the shelf for a minute. I have a drawing board over here with markers and whatnot, and we're not going to go through the equation, okay? We're not. I want to look at something simply in terms of the presentation of volatility to you today in the form of the specific standard deviation of 2. We're going to start with 2, but I want to include a standard deviation of 3, 4, 5. I want to make sure that you understand that there's opportunity and there's consistency and a cyclical expectation of cyclical volatility within what you trade. And so, yes, we have. Let me take the signals off of our Bollinger Band tool. It's a Bollinger Band, but it's just a standard deviation, and I don't confine it to Bollinger. I don't, because we're looking at the 1, 2, 3, 4, 5, 6, 7. As much as the range in price will represent itself above or below a moving average, we're interested. I don't care about the 2. The 2's fine. If it's relevant to me to trade, I care about the 2 standard deviation. Our tool, as you're going to see, our tool here, I want to make sure that you get, there you go. On the right-hand side, let me see if I can make the scales a little bit larger for you. Good morning. Hope you're all doing well. Seems like we're pretty serious this year, huh? Seems like we're going consistently over some important information, don't we think? Yes. Now, where is my status line, OC value, scales? Where is my text format appearance? It's under appearance text. Let's go 20. Let's make it green. There we go. Now you've got a clear image there on the right-hand side. Anytime you see specific labels on the right-hand side, double-click on it, go under Style, and unclick that specific feature under Style. When you see that, go under Style. Let's say labels on price scale. I don't want those labels on price scale. Okay? Now, this is highly relevant because yesterday we were at a level of resistance. I'm gonna bring in the relevance of this discussion. Yesterday we were at a level of resistance. Okay? I'm gonna walk you through how this transpired, what happened. Heat map. We were at a potential level of resistance, okay? This blue line is the 200 weekly. It's an important level. You'll find it on Microsoft, very important. You'll find it on Bitcoin, very important. You'll find it on some of these premier tech considerations. Very interesting. Look at the Microsoft chart. Now, when we were at this level here, I let our VIP know, our trade group, I let them know when we were here that orders were stacked below here. All right, orders were stacked. Now, let's talk about on our tool, where were they stacked? In terms of volatility, what were the expectations? What were we looking at between on the examples? Pegged at 1? No, we're moving around. We're moving around. The 1 to 0.5 to 1.5? Well, yeah, I mean, we're expecting to consolidate. I'm expecting some conformity around where what we're looking at immediately, right? I'm expecting some volatility. Is it really the third example of the 1 to 0.1 to 100, though, or to 5? Sorry, if I can get that one right. There we go. The 1, what was it? 1 to 0.1 to 10, which was the 100x. Don't know how the 5 got in there. That's okay. So is it really that third example of a 100 times the money? No. So we're in that second zone. We're in that 1 to 0.5 to 1.5. We need to identify something that's within reason, right? We just moved. It was a nice move up. It's a nice way for you all to think about your volatility and your entries and your exits and your targeting. Now, I want to explain exactly what occurred why there were orders waiting below, and cyclically, how you start to see the specific, and pay attention, please, looking at this, just go ahead and assume this 0.5 to 1 to 1.5 to 1 to 0.5 to 1 to 1.5 to 1 to 0.5 to 1 to 1.5, 1. 0.5, 1. 1.5, 1.5, 1. You got it? Throw ourselves into that second example. Okay, volatility, not extreme volatility to where we're going to say that's a, just safeguard the keys to the ranch, lock and batten down the hatches. This is an extreme volatility situation. Is it? No. Okay, it's not the fallout. Okay, no apocalyptic volatility. It is not there, right? So as we were to look at this, and some people are attracted to that. I'm telling you guys, some people, are you attracted to apocalyptic style volatility? I could put the whole ranch into the trade, and I tell you, I could have 10 or 100 ranches, or I could have no ranch left, right? We could have no ranch. Let me have one sip of coffee. Thank you for that. Now, as we were to look at volatility, we have been consolidating. Nice move. Now, what's going to give you some expectations of your which zone you're in? What's going to give you some expectations of which example you're in from a let's see. I'm going to give you a couple minutes here to join if you'd like to join our VIP. I know that you've been here a few times and you can join our VIP this morning. We'd welcome you to join our trade group. It is a members only trade group. So I'll give you 5 minutes if you'd like to do that. We'd welcome you to our trade group. In terms of the specifics here, the pattern, the amplitude of the pattern that's in question, the fundamental dynamics of the market, and specifically as to the asset, global geopolitical, everything's built into whether or not you're in a mid-level, right? And whether or not you choose to be in a no-level volatility, whether or not you safeguard into a 1-to-1-to-1 situation. Your expectations in terms of the 0.5 to the 1 to the 1.5 in terms of this mid-level function and volatility, yeah, okay, versus now we're in the code red apocalyptic level of volatility. Let's go. Some people are thriving in that. Not just attracted to it, some people thrive in that. Some people drive those conditions illegally. Some people, the SEC has a long list, Department of Justice has a long list of people who are illegally driving apocalyptic level of volatility. When I see volatility just wham, interesting, very interesting. That's great. On the radar, probably. On the radar somewhere, probably. Now, one of the ways that we are able to capture pay attention, this is very important. One of the ways that we're able to capture the extreme levels of near apocalyptic, and guys, the heralded level of that extreme volatility is with leverage. Yeah, with leverage. With leverage, aside from the volatility discussion, but paired on into it, we are able to take the 0.5 to 1 to 1.5, that mid-level volatility solution that's presented to us, and we are able to turnkey, replace, and amplify the volatility into a third category situation of volatility. We create leverage on the mid-level solution, and we thrust into it and get the return deliverables both to the upside and to the downside. Okay? So in terms of risk assessment, you better believe it. All right? Now, when we brought up the notion that, well, some people are just attracted to that apocalyptic level of volatility, Everyone kind of sat back and said, well, that's not me. That's not me, right? When we discuss the leverage and we discuss turning this zero point 0.5 to 1 to 1.5, a mid level volatility situation, and amplifying it, I'm going to say that the permissible way to create levels of extreme volatility in your trade profile are with something that the SEC might know as leverage. It's not with a pump and dump scheme. It's not with a hyped up social media group and a fanaticized level of engagement upon something that has no real standard, no real utility, except for a social group that has decided to create an apocalypse within a huge stratospheric rise to the upside, or a meltdown, nuclear meltdown in terms of the price action. Guys, that's not really trading. That's not really trading. That's a falsified apocalypse, right? It is. So when you shield yourself away from something that, in terms of the market, the market, and maybe a high school, if we were to look at like a high school test, and I mean a test, a litmus test for you, could you go in and teach a high school class about what your last trade was, why you did it, how you accomplished it, and think about the difference between like a pro level, and we'll get back into exactly what this drop was here on the hourly and looking at the volatility, but I'm trying to mix in a few different features of who we are and what I want us to reinforce as a group, what I reinforce in my own trading. I know that you guys do too as well, you guys and you ladies and gentlemen. As we look at the and said individual has decided not to join. No problem. So he gets hidden from the channel. I don't like the distractions for our VIP. YouTube recommends that we use membership, and I insist upon it. So as we were to look at the high school test, could you go do a show and tell presentation at a high school? At a high school test, could you do a show and tell presentation about the fundamentals of your last day trade, your last ringer? It just went, I just made 20 times my money. Hey, I just made 20 times my money. Could you go and give a fundamental presentation to a high school group? Would you be welcome there to go talk about your last trade where you made a 20x? You may say, man, that's boring, man. That's boring, huh? Maybe you want to be involved in the social media group hype. Maybe you want to be. You think that's the only way to make money is in an apocalyptic, almost degraded level of involvement. Someone might say, right? They're attracted to this degenerative, non-market fundamental interaction. We're not. We want to know what's the real turnkey, the professional turnkey level where we can look at let's say a grade 2 volatility. Right, that second example. Turnkey solution where I can get from a 0.5 to 1 to 1.5, let's say that level of volatility. What's the turnkey professional solution to where I can tell my kids about it? I mean, if I want to tell my kids about it, I want to describe the situation of how a professional would be able to do a turnkey solution, something that they could understand and digest and not be afraid of. So it's something that's like, the horror stories of leverage. Well, leverage, margin, things like that. Don't when you say margin, the whole world literally doesn't just it weighs up in on your back. It literally emotes an emotion. It provides an emotional response. Margin. Oh, it just doesn't it? Because you hear a margin call. We've seen the movies. You understand people just get liquidated. People get forced out of their positions. The margin call. Listen up. People understand a margin call. What's a margin call? You don't even know what it is. It is a call from the banker, from the broker, etc., and you're going to have to give us your house now. Oh, no. We have this. We grow up with this. It's reinforced by the media that we watch, by the movies that we see. It's the dramatic situation where there is literal, the Mission Impossible force is there, and he has one more enemy bad guy, and it's a single bullet at the end of the round, and it's that high suspense thriller style. Potential catastrophe, save the world or not, it's a big deal. We're reinforced almost to that level, literally preconditioned almost to that level. You understand the Mission Impossible, yeah. You have that understanding of margin call. Everyone has an understanding of a margin call. Just fear, sweat, literally instilled in the individual. Cortisol levels go up. They're ready for fight or flight. Margin call. They couldn't explain it to you honestly. They couldn't honestly explain it to you if they had to. But it's still going to be this cortisol fight or flight experience and a margin call. Hey. Okay. So as we look at the proper solution for a volatility turnkey solution, I want to get somehow I need to get from the one. Our goal as traders, I want to get from the one to this second solution, at least for purposes of evaluation. And this is the nice thing. For purposes of evaluation, I want to get from this 0.5 to 1 to 1.5. I at least want to get there. At least let me find something I can trade. You got it. And then if I want to turnkey that bad boy into this highly volatile, forget the apocalypse. This is trading. These are all recognized fundamental approaches to the market. You know how long they've been around? Man, I grew up in high school with this stuff. Literally in high school. I grew up like in the futures, literally pouring through futures in high school, man. Yeah, watching people get scared out of their minds on a blockbuster movie about a margin call. Man, I grew up in high school with this stuff. Yeah, they're still doing this with the margin call and everything else, right? As you look at the turnkey opportunity, you may say, that's fine. I want to find 10. Maybe I want to find 10 opportunities that I can trade 0.5 to 1 to 1.5, a mid-level volatility solution, right? I may only turn the key on one or two of them. I may only turn the volatility key on one or two of these, but at least let you understand that the option is there. I don't mean like options, margin call. Your possibility is there to turnkey a solution onto and based upon technicals that you would evaluate. Okay? I'm going to turnkey two of these bad boys, no problem. Yeah. Let's go. Throw that into the high-level gauge, high-level volatility. Let's see what we can do with this. Huh? Now, I bring that up just to reinforce and talk about what we're discussing here today. Okay? And it's not a bad. Is there 2 more hours or 3 more hours or 2 more days or 3 more days to that conversation, or 2 more weeks or 3 more weeks or 2 or 3 months or 2 or 3 years? Hello, without a doubt. There's a near a lifelong process to evaluating that and going through the process, and that's how much I like. That's how much I enjoy that as a solution. Just by the way, that's how much I enjoy that as a solution. Yeah, we could go on literally almost forever with that. I really, really enjoy evaluation in terms of your participation in the market, our participation, looking for things that we can trade, looking for turnkey solutions. One's going to be towards higher volatility, right? Would that mean that you would you throw a few of the tradable solutions and gear back into a peg 1-to-1 on the other side? Would you balance those issues out? Would you say, okay, I've got a mid-level solution I can trade, a 0.5 to 1 to 1.5. Okay, I've got that going on. Then I've got a turnkey solution with leverage or otherwise, and I can increase my exposure to volatility based upon a lot of work. Okay, but we're going to go through some of that work. And because I'm doing that with the turnkey solution into a higher volatility level, I'm going to go ahead and flip back a few of my trade opportunities and safeguard back over into the 1-to-1 peg. No volatility. Things become interesting. To me, it would sound like you know what you're doing. To me, it would sound like you know what you're doing. Now, to be able to express that and to be able to conceptualize it, that's why we have the group that we have. Okay? It's what I enjoy doing. I know it's what you enjoy doing as well. And good morning to all you. Hope you're doing well. Now, I'm going to take a look. Okay, now in terms of volatility, on your specific Z-Pack indicator, I want you to please pay attention. Please pay attention. As you look at the green band and the purple band down below, you'll notice the cap line feature. First of all, the cap line feature. Let's go ahead and go to inputs. I just want to look at the cap line real quickly. The capital control line, capital, your capital. You're investing your capital. I want to give you some sort of a gauge in terms of your capital, the red, the white, the blue, time frame dependent. Now, you can have the red, white, and the blue, white being transitional. You can go into your settings and show only the capital line. This is bearish and bullish control of the markets in terms of the buying and selling pressure. It's not invented. It is force multiplied on in through relative strength index, MACD, stochastics, and momentum. Literally calculatively, I can rip pages out of a book if I choose and equations and hold them up and literally paste them back together from this material authority, this material authority, this material authority, and boom, and stick them together and literally bind it and take it, and these are our equations. I go, oh, wait, you took relative strength index. Hold on, you just took the relative strength index, someone would say. Oh, really? And they'd say, oh, wait, you took stochastics. Be like, really, huh? Okay. Then they would say, oh, wait, you took MACD. Like, oh, really? Okay. Then they'd say, well, you also took some Bollinger Band, moving average. I'd be like, oh, really? Okay. That's the notion. That's the idea. I want to encapsulate as much as I can and add and deliver up and above those features. And it's not once you see the additional features, you're going to see that even really with your RSI, your stochastics, your MACD, and your Bollinger, you're going to say, no, hold on. This is better. I'm going to show you why. Now, and for those of you trading on it, you're going to say, no, it is better. Okay? Looking at the capital line, we have, let me see if I go to, let me see if I've got down here. Give me 2 seconds on our specific settings. Candle coloring, turn on candle coloring. That'd be nice if we go to candles. Looking at, what if we go to Pro? I can leave this off for now in terms of the transition mode on your transition mode. Transition mode on your capital line. We want to know when you go from bearish to bullish on a time frame. We just do. Like on the hourly, right? Right now, you just caught the move to the upside on the capital line. It just went from, if you see on the right-hand side here, it just went from the red to the white to the blue. You see, the red to the white to the blue. You just caught that move to the upside. Boom. Now, you see the white is a transition. If I go to extreme on my capital line, okay, if I go to extreme, and I'll expect that we've got some filtered in differentials here. What am I looking for that I want to show you right now immediately? It's probably going to be on the none in terms of transition. Let's go to none first. We'll talk about extreme after we cover the actual volatility. Extreme is not going to have any transition mode. Just so you know, it's just going to be red. There's no white. There's no transition. It's going to require a direct feature from the red to a different color here, but it's going to be essentially called that blue, okay? You see the red to the white to the blue. If you were to look at the transitional feature, that transitional feature is helpful at times, but we also have without the transitional feature. Just understand that as you use your capital line. If I go to transition mode none, let's see transition mode none and allow that to load very quickly. And I have the divergences on the side here. Transition mode none is a nice example as well. We'll go through, I'd say in more detail in another video, which specific transition mode, if any, you should use and how it relates to your risk involvement. Okay. You may decide to get in at a turn of blue in terms of a bullish change in the market and say, okay, and I'm going to talk about exactly what this is, and talk about, okay, blue, but I'm out at the first possible transition mode. I'm out. If the bears start to engage on the bulls, I'm gone, right? You'll have your own conditions. Now let's talk about what the transition mode is. And the context today, this is very important in the context of the volatility, okay? Now the volatility, I've surrounded the price on top with standard deviations. That's it. I need some way of measuring. As I were to look at moving average, okay, moving average. That moving average, the green, the red, the green above on your price action, I need that moving average just to level in and be consistent on my oscillator down below, okay? Because I want to visualize very clearly what the limits are. Please pay attention. What the limits are on my example in which I find myself. Am I in a situation of B, okay, where I've got the 1 to 0.5 to 1 to 1.5? I need to see it. How am I going to see it when price is all over the place on my chart? How am I going to see that? I need to normalize it, which we have on this indicator. And then I have my baseline average, and I'm given standard deviations to the downside and the upside. Okay? Hits at either the 2. Let's just look at this. The 2, the second standard deviation, here. The 2 would be here. Sorry, the third standard deviation would be here. The fourth standard deviation would be up along the top. But look at how many times the fourth standard deviation is getting hit. I mean, I'm going to go ahead and agree with you that Bollinger, I don't think he's right. Like I say, I don't think he's right because look at this. This is the price action, for instance, of Bitcoin. I mean, that's fine. He wants to center everything around the second standard deviation. That's fine. But look at this. 1, 2, 3, 4, 5, 6, on nearly 7, 8, 9. I mean, look at this. There's 10, 11, 12. Look at this. There's 10 to 12 to 15 hits on into the fourth standard deviation. Come on. In the last month. Now we're on the hourly time frame. That's on the fourth standard deviation. That sounds like those could be big trades. Now, that's at the fourth standard deviation. What is Bollinger famous for? John Bollinger. He's around. I'm not criticizing him directly or personally, not an attack at all. But I want more. Because when I use the standard deviation of 2 on Bollinger Band, I do now all the time, and I did early start to skip that chapter because, well, he's only interested in the standard deviation of 2. I know that's a New York pro-level tactic recognized by the New York Institute of Finance, where Wall Street traders go to school. But I want to know, why is he hitting into the fourth standard deviation? And I mean, you have to admit, if I were to put standard deviations all over my chart, I can measure this, but the majority of people will sit and use, they're going to sit and use a Bollinger Band with a standard deviation of 2 on either side. And I mean, you got to say, I feel like they're missing quite a bit of the equation because, I mean, look at this. I mean, sure, the 2 is relevant, but look how many times we're hitting way above 2. Way above 2. So the moving average is the middle line. On the right-hand side is the level of standard deviation for 2 or 3 or 4. Targets. Now, whether or not these targets are going to act as a reversal or whether or not the targets are going to act as a continuation. We have similar discussions with RSI, talking about whether or not, well, it's overbought. Okay, does that mean that the bulls are ready to reverse or that they've gained momentum and we're going to drive up into it? What other factors and considerations are there on that evaluation? There are a few. We'll go through those. For now, I want you to realize the following. First, the construction of the volatility. The construction of the volatility as presented to you in this fashion. I'm not happy with just a 2 standard deviation that would come with a Bollinger Band. Man, that's like first grade stuff. I'm going to add in additional standard deviations. I want to know the 1, 2, 3, 4, 5, 6. I want to know all of these. I just do. That's up through 5. I'm going to add in. I'm just going to do it. I'm adding in up through 6. I may add in more or less. All I did to add in an additional one, I added a BB, a Bollinger Band, a standardized indicator. All right, I just added it in. All I have to do, it's like it's contemplated, right? Changing this standard deviation. I clicked on the 5th one. All I did was click on it. I put Control C, Control V, copy, paste. That's it. I want another level of a standard deviation here. Fine. I'm going to copy, paste, and then I'm going to change my standard deviation, and boom. Now I have up to 7. What I'm trying to get at is the level of volatility. A lot of different ways to define volatility. But I want to know, because in the context here of operating around my moving average, I'd like to know. And this allows me to know, in terms of the volatility, the construction of what we are looking at is a hit into the 4th standard deviation, not just the 2nd, into the 4th standard deviation. Okay? As reference or as shown by our indicator. A hit here, nearly almost to the 4th as well. Real close. Boom. Nice trade here to the downside. Boom. Nice continuation to the upside. This here. Boom. It's not at that 2. Forget Bollinger for a minute because I just don't even see the relevance of it. I see the relevance of the 4th standard deviation. All right, I want to know this thing's got to move. And on top of it moving more, hold on, I still have my turnkey on leverage. All right, but I'm putting that turnkey on leverage to get me from the second example of a consistent 0.5 to 1 to 1.5. Right? And my turnkey solution is really leverage, which is respected. It's available legally. The SEC knows about leverage. They literally have the guys. They have partnerships with for anti-laundering and what they have governmental agency partnerships with leverage exchanges. It's not like, ooh, that's taboo. No, there's enforcement regulation on everything from, I don't want to talk about stocks, equity side of things or commodities, but in terms of crypto, it's okay in the USA and abroad. With that said, back to the construction. There's another hit at the 4 standard deviation. Well, man, what happened to John Bollinger? Man, what happened to Bollinger? Well, I got to tell you, I'm looking at hits here. I'm looking at hits at the 4. Boom. Now, there's 2 ways to look at this. There's 2 ways to look at it. Like yesterday, we were at a potential level of resistance. We were at the 200 weekly moving average. All right? Orders were stacked below. Boom, 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 boom. Heads up was given to our traders. Orders are stacked below. Where? Up here. At what? At that 200 weekly. Okay? Now, in terms of targeting, there are 2 approaches. There are 2 approaches in terms of targeting. You may say, great, orders are stacked below. Well, I'm going to set up at 3. Look at this, the preceding pivot right here. I'm just going to go with that preceding pivot. I want my order right here at the preceding. Look at this. 1, 2, 3, 4, 5 hits at that 3. I'm in. Give me exposure at that 3rd. It's really the -3, right? The -3 because it's under the moving average, right? So we have the -3, we have the 3 above, okay? It's the equivalent of that 0.5 to 1 to 1.5, okay? In the example of the volatility. But I see right here, look at this. Bitcoin's just wanting to hit, 1, 2, 3, 4, right in this level. I'm going to go ahead and stack my orders there. Now, what does it mean? Well, it means that based upon the moving average in terms of the construction, that moving average, right? And it looks like we have some interest below. Looks like we have some interest below even at that -4. But you see some normalization, some reinforcement, some pivots at that -3, right? Orders are stacked. What does that mean, stacked? Why did I use that terminology with our traders? Why did I use that, guys? Hmm? Why did I use that? Because you have a level. I see. You have a level at -3. Oh, I see. And you also have a level here at -4. Oh, I see. Stacking orders. Boom, 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 boom. Indeed. Okay. Stacking orders at a -3. Stacking orders at a -4. Pricing is right here on your right. As you approach the levels, the pricing on the right becomes more relevant and more accurate as you approach the levels. And why would it change? Because your moving average is changing. As you operate underneath the moving average, as sellers and buyers operate underneath the moving average is coming down, which adjusts your calculation of your deviation and your target entries. Okay? Watch these. Work with them. They are your friends. Now, as we were to look at the exact construction of what you are seeing here is the following. You're seeing, as we see, a hit at the third standard deviation, bam, over the moving average, which is a mid-level line. Okay, that mid-level line, the central line is guys, that central line is the threshold. I'll just say the threshold of this moving average you see above. I can change it in the code to 5. I can change it from 20 to 5 if I want to. I can change it. We can change it to whatever we want to. So the 20 is relevant now. If you have another favorite moving average and you just can't separate yourself from it, we could make it a reality in terms of your ability to trade it. Okay, the 20 is there for now. And as we look at the standard deviation of, let's say, the hit at 3, boom, what does it tell us? From that mid-level moving average, Z1, Z2, Z3 is what? That's a hit into that third standard deviation, boom. You see this? Yes, the 1 standard deviation, the 2 standard deviation, the 3 standard deviation. Now, again, back in through here. Just watch. And before you judge the trading, immediately you're going to want to judge the trading outcome. Don't do that yet. Don't judge the trading outcome until you fully digested the capacity of your ability to participate in it. On which side? Both or either or neither, right? Look at the hit here. Okay, as we were to look at this, and if I add on, let's go ahead and add on. This is one of the issues that we'll probably be updating at some point. Let's go to a 1 over 100. Let's go into here. Now, as we were to look at the specific hits, we start to get into some fractional details, which is probably going to require a full screen at some point if you really delve into this, right? A 3.37 hit. What's 3.37 mean? Well, we have our mid-level function, the moving average of 20, right? That's 0. That's our normalized line. That's our baseline, 0. We went to 3.37. 1, 2, 3.37 in this area, okay? Got it. Why is this important? Because you're seeing right now in terms of the construction that in this time interval, in this area, you operated where? The breadth of this candle is what? Is literally here. This is the candle operation. The bulls and the bears operated within. If I were to look at this specific threshold limitation of 1.69, please pay attention. 1.69 coincided at that level with a specified what? Specified price. And so when you're looking at this band here, it is telling you exactly what the bulls and bears did relative to a moving average. Okay? It's telling you exactly what the bulls and bears did. Where the bulls started, guys, or where, let's just say the range. We should probably say the range. Where the bulls started and ended will be on your candle. Okay? We can make some adjustments. Let's just say the range right now. Okay? Your candle start and finish with your max volatility is going to be encapsulated by these this I don't want to say band, but by the your lines. Okay, it's a band, but I don't want to call this a band because we have additional bands we could lay over the bands. All right, just pay attention. But this minimum back to series 1.61 is on a volatility basis based upon, and this is where it gets good. This is standard deviation of 1, this first line. This is the 20 moving average. Standard deviation of 1 is here. Yep. Then we have the 2 here. See that second standard deviation. Then we have, guys, this always looks better on a big screen TV. Dig in on a big screen TV. We look at a standard deviation of 3. So this is 1, 2, 3. Yes. This here is at 1.61, was it? Okay, so literally, bulls operated with a minimum and bears with a maximum at 1.63. Bam. Okay, relative to this standard deviation of 1, standard deviation of 2, standard deviation of 3, standard deviation, as we would continue to go on up to 4, to 5, to 6. Volatility. There are other ways to measure, but this is the most clear and forthright example, simple and straightforward example of how to measure volatility. We have to have some sort of a average, some sort of a, as the hourly are in play on BTC as we speak. Yes, indeed, hourly, without a doubt. Thank you, Venus. Glad you're paying attention. I know that you are, always. So as we look at this threshold minimum, as we look at the operation of the bulls and bears from a construction standpoint, I need you to understand that what's being provided to you in this range is almost like this wave of volatility. It almost is, isn't it? This wave of volatility that's going to the upside with a line above and a line below, an encapsulated level of limitation from the bulls and bears in terms of price action is reflected exactly by the candle in the actual price chart that we've thrown down and normalized around a 20 moving average. So this is the volatility, but it's provided to you in the following way, that you don't have to have all of these standard deviation lines everywhere, all over your chart. You can. You definitely can. But when you look at it, let's say a reading of 4.63, 4.63 on the right-hand side means maximum you got up to 4.63, and the minimum is important as well. The minimum here, meaning you operated, the bulls and bears operated at a minimum 1.61 to the right. That is reflected exactly in your specific standard deviation lines away from your moving average. Understand? Away from your moving average, the bulls and the bears operated on this specific interval at the minimum standard deviation of, it was a 1.63 up into this, let's say 4.5. Literally on the bands above, you would see bulls and bears operating from 1.63. Now this is 1, this is 2, 3, 4, 5, 6 standard deviations. Those are the standard deviation bands that I have laid out. But understand that that's the measurement feature. That's the construction in play. You get it? This 1.6, what does the 1.6 mean? One more time. As you look at the scale on the right, it's telling you this standard deviation of 1.6. Not quite to that second standard deviation line. Yeah? The 1.6, boom. That's the low on your oscillator that's being measured. What's the high? Okay, I got it. What's the high? Well, the high is The 4.61, 4.61 what? Well, that's the maximum that the bulls and bears got to in terms of the 1, 2, 3, 4 standard deviations. 4.6, not to the 5. Not to the 5. No, they didn't make it. They capped out at 4.6. Bam, on your scale. So that's brought down that price action, the exact price action that the bulls and the bears are engaged upon is brought down for you to visualize. And how does that become relevant? Man, I'll give it to you. Whatever. You're going into standard deviation. You're measuring volatility. I get it. But what's the point? That you're given a visual here of how many times we're hitting into the specific level of standard deviation, into this seemingly chaotic representation on the screen is a level of cyclical price action wherein there's an expectation from the 0.5 to the 1 to the 1.5, from the 0.5 to the 1 to the 1.5, and we should say back to the 1 to the 0.5 to the 1 to 1.5. Yeah, you're starting to see, yeah, there it is, because I get to look at this. I visualize all the hits up and above 4. And what is that hit? Again, it's just the bulls and the bears in terms of the construction. It is literally a hit up into, as you see it below here at the 4, literally 1, 2, 3, and 4. We got it. On the right-hand side, you're seeing that volatility play out. The exact, and I bring up the low to the high in terms of the volatility gauge below because it's relevant. It's relevant that you know that all the price actions encapsulated into on a standard deviation basis surrounded by the moving average, or I guess it's operating around the moving average, rather, operating around that moving average. And how is that relevant again? Just understand. It's highly relevant because you're operating underneath, bulls are operating underneath that moving average. It's going to be that dotted line, the baseline. And you're seeing, oh, I see here. So the bulls and bears operated underneath the moving average and above that moving average within the range expressed by this wave here. We call it a wave. We'll come up with the proper name for it. But these two lines here, oh, I see. And now the red, white, and blue is not the moving average. The red, white, and blue is not the moving average. Your moving average is going to be this small dotted line here. So you got to stay focused on this. One element you have to stay focused on. But yeah, I see. Okay, great. The negative 0.86. Negative 0.86 here on your volatility gauge. I see that. I see that's the minimum in that specific time interval. Negative 0.86 means what? Okay, that means negative 0.86. Not quite the negative 1. Negative 1 would be one standard deviation below that moving average. No, it's negative 0.86. So they were right here. Negative 0.86. Bulls and bears operated right in this zone. Up to, they got to that 1, 2, 3, 4, and then some, not quite to the 5. You see that? So they got to the what? They got to the, and we'll have to look at, where are we at on this? Let me really zoom in here. 1, 2, 3, 4, 5. Now I'm going to show a 5.5. And don't tell me my programmer is busy right now. Do not tell me my programmer is busy right now, because if he is, this is great. Good timing, Vasil. And my programmer is literally programming right now on this. He just asked for my password, and so he's into this right now. So that's great. Good job, Vasil. So your 5 or your 4 is going to demonstrate your 1, 2, 3, 4, and 5 hits on your standard deviation. Venus, if you would, please help me mark the time in the video. That would be great for me, because I just woke up at 2, 3 a.m. and we're working on the, just let Basil into the account for purposes of providing some spacing issues as we're dealing with the moving average. Okay, this so that it doesn't get over the top of your specific indicator. I'm trying to adjust that so you guys don't have any problems with that. If you need to adjust the spacing, this here and this here should allow you to adjust the spacing on your indicators, okay? Very important. So, looking at the elements in play, the features, what you're looking at as a target, I'm going to point out two things for you. Two things is one, you can use your target as a specified entry, either long or short, below or above. Pay attention. You can either specify an entry below, like yesterday we did on the hourly. Let's look at the hourly. And thank you, Venus, if you were so kind. I appreciate that. As you look at your feature below or above, as we called out stacked orders below at this 3, and then we hit down into the 3. That would be 1, 2, 3. Boom. Okay? That third standard deviation was hit. Okay? As we were to look down below 3.16. All right? 3.16 was actually the level, and the preceding pivot to the left that engaged. Orders were waiting at the 4. I'll tell you, orders were waiting at that fourth standard deviation below. It didn't get hit. The third standard deviation picked up. Okay? Doesn't mean orders weren't there. Now, those who hit the third standard deviation to the downside, again, the measure of volatility, the 0.5, the 1, the 1.5, we want to operate in something with volatility. Normalized and cyclical, all the better. It's more predictive. It's more predictive that we can operate within a range of volatility. Bravo, that's what we want. As traders, we want to identify these cyclical events. And in terms of the volatility we've been through, just encapsulating exactly what the bulls and the bears are doing. And there's a breadth to it. There is a function here of a wave line, some sort of a price line that's encapsulated and defined by the maximum and minimum in this range of the expression of standard deviation, right? We've gone through that, I think, enough to where we understand that's the minimum and that's the maximum, okay, in terms of the bulls and the bears based upon a standard deviation around a moving average, okay? Now, as we were to take these lines off, as we were to remove all of that, at some point you'll have a good enough understanding. And if you walk through those Bollinger Bands, essentially identifying the moving average and the deviation away from that away from that moving average, as you do that, you'll need less on your screen to understand it. It'll be automatic. You'll be able to trust more what this -3 is. You understand what the -3 is. You also understand now, what is this? Okay, I understand -3, but what's this part? Why does this have a breadth to it? Why is there an amplitude here? Because that's down to the -3 standard deviation. And let's say up into the max was a -1.45. -1.45 and down to a 3. Okay. Of what? Of the standard deviation around, hold on. The standard deviation around a normalized, there you go, boom, 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 boom. All right? The goal is so that you don't need all these all over your screen. And you can do what? What is the real advantage that we have here? First of all, conceptualize, visualize the cyclical historical volatility of something that you're trading, and to be able to participate and to anticipate. Let's say, first of all, anticipate might be better, than to participate, because you'll define how you'll participate in a hit down into this level. You see how many, how cyclically important is it that you are continuing to operate down into these levels of a -3 or a -4 or potentially beyond? How is that important? Well, it's important because people are going to stack orders. There's going to be a twofold group, and maybe 3. People are going to want to stack orders down at that -3 standard deviation. It keeps going down there. I want to buy there, right? It's going to go back down to the -3 standard deviation. If you're watching this, you're watching it play out, you're like, no, man, it's going back down there. Look at this. Look how many hits down at the -3. Like, you're almost like, I know it's going to go back down there. Against all odds, against the direction of the movement, I know it's going to hit back down into a -3. Look at it. It keeps doing it without fail. I mean, look at it. Look at this. It keeps going back down into the -3. It keeps going back down to the -4. I mean, you can tell me the price is going up, the price is going down, it's doing whatever, but look at this on the hourly. You ain't going to stop it from, you're not going to stop Bitcoin from going down and hitting -4. Now, identification, big deal. You want to project into where it's going to, I mean, it's going to hit this level again. There are orders waiting. And as you look at it, okay, people want to stack longs below. But when you can start to identify the cycle really well, when you really start to be able to identify the cycle and say, okay, it's going to hit down into the -3 in terms of a volatility gauge, we know it's going to go back down to -3. Look at the number of hits back and through here. -3, -3, -3, -3, -3, -3, -3. You got it. Stacked into and respecting -4. Some hits into -4 and beyond. We'll talk about how to get to that extreme mode and beyond. Two camps. One camp wants to stack longs underneath at the -3. What's the second camp? Well, the second camp wants to ride down to the -3. Right? Yeah. One camp wants to stack orders below at the -3, saying, man, I know this. I know this is going to go down to and hit again the -3. It's going to do it. I got my orders stacked. I got my longs stacked at -3. Come to Papa. Come to Mama. Let's do this. -3. Look at this. Boom, 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 boom. You got it. Trade, trade, trade. Yeah. Now, that's one camp. Trade, 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 trade. You see, trade, 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 all these trades. Yes. There's one camp. Stacking the orders below, like we said yesterday, right? Yep, they were stacked at the -3. There's two camps, though. One's going to stack their orders below, and the other camp's going to write it down too. The other camp wants to write it down, maybe even stack with, and you guys got it. I'm going to write down and stack. I'm going to get the short and the long. That's maybe that third category, because one group wants to participate in stacking orders at that -3. Another camp wants to participate and write it down. So you got longs waiting. You got shorts writing. And then you got maybe a third camp of traders that's going to say, I'm going to write it. I'm going to stack it. Here we go. Best of both worlds. Right? I'm going to take over the market. King Alexander moment, huh? It's mine. Market makers have never seen you coming. They must, if you're good at it, they love you. They love you. Now, as we are involved in the red, white, and blue, look at this. It's on the screen. Call it blue, white, and red. Huh? It ain't France. I'm telling you, it ain't France. Okay? Their flag, huh? Yeah. There's a lot of red, white, and blue. It is what it is. These are the most visually distinctive colors. Before we go any country, these are the most visually distinctive colors. We tried light blue. We tried green. We tried green mixes with white. We can't see the green, or we can't see the white in transition. We can't. Let's see what we got here.
Down. Alert 4 hours top pro line.
All right. Now, hold on. Not me. There. Sorry about that. So the red contrasts extremely well with the white and contrasts extremely well with the blue. If we were to have green and red, you don't visually see from any kind of a distance, because I like the red and green, the buy and sell, easy stuff, the long and short, but I can't see a visual distinction between the green and the white. So I incorporated the blue instead of a green so that I can see a visual transition. So we do have the red, white, and blue on a capital control line. Capital meaning if we turn red, be prepared for what? Be prepared with capital below. Just capital below generally, or at least a hit into, and this is what I like, at least a hit into a 20 moving average, a possible hit into the 20 moving average. Okay? Now, what does it mean though if we turn red? If we turn red, it means that the bulls and the bears, as we were to look at all of the standard deviation measurements, you guys got this. It means that the bulls and bears are operating below their own defined average volatility. What is their average volatility? I already talked about real easily what is a 20 moving average. Simple stuff. 20 moving average, this middle line. That means over the preceding 20 periods, I want to know what the average is. Bam. Preceding 20 periods, I want to know what the average is of price. Boom. Yes, 20 preceding periods, I want to know what the average is from right here, the 20 preceding periods. Boom. Now, on our volatility gauge, we have a separate, it's a kernel regression formula. It is a weighted moving average, but it's a kernel regression formula. Kernel regression formula with a K, meaning what? Nearly at a machine learning level, kernel distributions, kernel evaluations. Rub your palms together, MIT, Massachusetts Institute of Technology, Highline Thinkers and Programmers, machine learning, kernel regression. It is still a weighted moving average. It just is, okay? It's a nice, clean formula to get you an average of what? Not anything necessarily above, but you understand that, yes, the volatility here is averaged below in the form of a kernel regression weighted moving average. You like it. We like this. It's a good thing. All right? Now, as you were to look at the following, this capital control line underneath, what does the capital control line mean? Good morning, J Mac. Good morning, my man. What's going on? California in the house. J Mac, what's up, my man? J Mac, boom, 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 bam. Trader, yeah. So the volatility expression, this low to high in the period, that is all referenced around this moving average. The low to high of the standard deviation that we can see in a period up and over that midline moving average, the bulls and bears participating at the specified level herein, right? We're taking the average of that. I'm taking a kernel regression formula, that capital control line. When it turns red, now you're going to find, like with any calculative or expression of volatility or otherwise, you're going to find some normalized characteristics that are more or less valuable. When we have a transition from red to white to eventual blue, the volatility of the bulls and the bears, the expression of price, the demand function essentially is operating up and over a kernel calculation. Okay, so when bulls and bears are operating up and over, now it doesn't mean we turn blue, we're up and over the 20 moving average. Ooh, John Bollinger. No. We're looking at the volatility as to whether or not it's up and over our kernel regression weighted formula here, our weighted average in terms of a volatility gauge. The buyers and sellers, the power of the bulls, power of the bears. Volatility has skipped, boom, to the upside. There's a pickup by the bulls up and over a calculative here. It's not too complicated, but it is statistically highly statistically relevant. Core, fundamental, statistically relevant. Hello. Yes. But that's what that is. When we turn blue, our volatility gauge bulls picked up and over. Okay, that's the shift that you see is operation of essentially price and relative to the relative to the price action, the behavior, the buying and selling pressure from the bulls and the bears. But we are looking at it from a standpoint of volatility. And as you do understand, and I know that you guys get this, you do, and guys and gals, you do understand within the parameters defined by the specific standard deviation gauge is really negative -0.5 to 0 to 1. And so that kernel regression, that capital line is demonstrated to you from with a color code. Bulls and bears are up and over their kernel line. Their kernel weighted moving average here that we're looking at in volatility. Okay? It's just a nice average. It's a real nice average. Okay? But it's not the 20 moving average above. That 20 moving average is normalized here. It's a flat line for us. 20 moving average never moves. Okay? Now, I want to know the average of the buyers and sellers in terms of the standard deviation. Mm-hmm. I want to know what their average is, how they're participating in terms of a volatility gauge that I can capture and that I can schedule into. Boom. What was that? Man, what was that on the 15 minutes? I don't know what that was, but look at it. Look at this. Okay, so in this time frame, boom. Man, they hit up into that 4. They hit that 4 again. Completely forget John Bollinger just for a minute. Not hard for some of you. But as you look at the 4th standard deviation, oh yeah, hit, boom, into the 4th standard deviation. Boom, 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 boom. You see? Yes, boom, up and over that specific moving average. Bam. Beat your hit right into it. Now, two camps. One, as we were to look at this, one camp wants to have orders waiting here, which are going to be shorts. Waiting at that 4th standard deviation because they've seen it hit 1, 2. I mean, when did it hit here? How long ago was this? It hit here, but 22 hours ago it hit. Two camps. Two camps. One camp saw it hit here. Boom. Up and above that 4. And man, that was a good short. I want to catch the next one. A good short where it hit into the 4th standard deviation. You see that 4th standard deviation? That's what's on your scale here. And deviation from what? Oh, over that 20 moving average, which is what? Which is a normalized function. That's your yellow here. I see. So that was a good short, huh? Yeah, that was a perfect short here. 4th standard deviation. Anyone who had their orders set at the 4th standard deviation, and look, it's hit it before. It's hit it here. It's hit it here. It's hit it here. Here. Yeah, that 4th standard deviation is important feature on that 15-minute time frame. Has been thus until now. So two camps. One camp, people with orders waiting, long or short, right? Second camp, so it's a good short, huh? Okay, great. Okay, great. Well, so we're going to write it to that, huh? I want to write it long to the short. Yeah, I want to ride the expression up to the 4th standard deviation. I see cyclically it has a tendency to hit up into that 4th standard deviation. So I have two options. I have one, I can write it to the 4th standard deviation. Huh? It's going to hit it. It keeps hitting it. It keeps hitting that 4th standard deviation. Bam, 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 bam. All right. So what camp number 1, orders waiting. Yes, orders waiting. Camp number 2, well, that's fine. Let them short there. I'm gonna write it to that level, to that hit. Boom, boom, bam, 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 bam. It's the bulls. Bulls riding up in 2, huh? Contact. Bam, bam, right? So some will stack orders. Some will ride 2, either long or short. Right? They'll ride down to the longs with the short. They'll ride up to the shorts with the long. And some are going to want to do it all. The King Alexanders of the market. We're going to get it. Yeah. what was it? He wept because there were no more worlds to conquer, right? Was that King Alexander? You think he said that, huh? You think he did that, man? Weak, huh? You know, what? Start weeping because there's no more worlds to conquer, huh? Yeah. So looking at that, though, it's the gauge of I want to hit with my orders above or below, or I want to ride up to and while I hit those orders. You got to do a lot of work. There's a lot involved in being right 100% of the time in terms of the direction and the flow without scaling or stacking or laddering, right? There's a lot involved. You better be paying attention. This market can get away from you. Now, looking what helps. The patterns like what we caught this morning. Yes, indeed. What we caught this morning. Nice feature. I like to put this in terms of the reversal that we came in contact with. In terms of downside expectations, we ran into nice, a real nice fan reversal. Boom, launch. In line with a pattern, if you can wrap your mind around the volatility, the opportunities, the long, the shorts, levels of resistance and support, and you can compute in your understanding of volatility and even our kernel regression line here, that red, that white, that blue, if you can balance all of that and gain an understanding and make it operational in terms of your participation in it, something that you can enjoy, guys, without just saying, fine, I'm just going to automate it. I just want to automate all this, huh? Some I just want to automate all this. You can. You can. We may be able to assist you in that in the future, but I'll just tell you, I don't want you to automate a strategy that you don't understand. I really don't want you to automate a strategy that you don't understand, and you don't need to be a Rain Man, but just have a bit of authority over your ability to enjoy the success, or a little bit of mental understand what you're doing. Because if you're going to jump into something that you don't understand at least a bit of, you don't have to go all the way down the road, huh? I mean, we ain't driving. Rain Man, I think he drove the Ferrari. Was that a different movie, Blind or something? That ain't too cool, huh? Take a right, we ain't going there. He's so smart. Take a right. He's driving a blind Ferrari. We ain't going there, guys. But when we're driving the Ferrari, we want to know, nothing wrong with knowing like. All right, so this car's got a slip differential. It's got a diffuser in the back. Okay, great. That's going to give me a little more grip on the front and back wing going 200 miles an hour. Okay, I get it. At least know. You're driving 200 miles an hour. How am I sure this car ain't going to fly off the track? Well, I got the diffusers in the back. We got the front and rear wings. We got and this is how you dial in really how you dial in whether or not you got a soft or a real, loose, or real stiff suspension in the back when you're going to go around that back corner at 150 miles an hour. Okay. All right, I'm gonna go around the back corner 150 miles an hour. Yeah. Do you want it to slide? Fast is loose. You want it to slide around that corner, the back corner at 150 miles an hour. You're going to be all out. You're going to be floored on the Ferrari on the track. You want it to slide? You keep saying fast is loose. What does that mean? Well, that means you're going to be sliding all over the track at 150 miles an hour. Whoa, 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 whoa. I want you guys to understand trading enough to where you can have a good conversation about your participation in it. Because there are traders who are sliding through the corner number 3 at 150 miles an hour. And the good ones know exactly what the mechanic is talking about. The good ones know exactly what the mechanic is talking about. When he says fast is loose, fast is loose. Cut my suspension free. Let's roll. I need to take it at 157 miles an hour. Loosen up that suspension. Let's get on the track and let's do it. Yeah, you guys got that right. Okay, there's nothing uncool about knowing whether or not you're going to fly off the track at 157 miles an hour. Man, today you're going to be racing such and such. And they took that at 158 last time. Man, we are maxed out on that rear suspension. What else can you do for me? Can you dial in the diffuser, the rear diffuser, or the front wing? What can you do? Actually, we're going to take the rear wing and loosen that up a little bit. We haven't done that yet for you. Go run it on a qualifying lap. Run it on a qualifying lap. We've got the diffuser, air diffusion, air systems, right, on the back intake underneath the car. We've got that maxed out. Okay. Now the back wing, we're going to dial that out. Get out there and run it in a test lap. See what you could do with it. Yeah, the guy you're racing today did 158 miles an hour around turn number 3. Let's do it. Let's do it. You got to perform in the markets. You got to know what you're talking about. It doesn't make it uncool. Okay, that I need to understand volatility and what it is. You're going to get out there with a bunch of pro traders, and you're going to try and pro and novice traders. You're going to try and outcompete them and make 20, 30, 40, 50 G's in a morning. Maybe you're going to try and make 100 G's in a day. Maybe you're going to try and make $1 million in a day or a week or a month or a year. In a day. Yep. Maybe. Maybe that's your goal. So the level of technical know-how is relevant to your participation in the market at high levels. Bottom line, you guys know this. Yes, indeed. And so as we look at the technical componentry here, understand that framework of what's going to make you and keep you competitive on the track, what's going to keep you from flying off the track, what's going to keep you in terms of the competition, knowing what you can adjust and otherwise. What are those turnkey solutions? If you didn't hear the entirety of this message, I'm going to save it so that you can go back and review it and other people can review this talk on volatility. Turnkey solutions. What are the appropriate turnkey solutions? Who's the champ on the track overall? Is it this group that gets into a small Discord or chat group and knows how to pump and dump something? Oh, those are the champions on the track. Negative. The champions on the track are the ones that understand the instrumentation, their volatility, the opportunities, and these turnkey, I'd say, solutions that we have to identify volatility, cyclical pricing events, and to amplify or multiply the potential returns while mitigating the risk. Hey, yeah, in and around, guys. As I talk about, I talked about the high school example. Can you take your last trade and can you go talk to a high school group about it? Could you? I hope so. Could you be like a not a model for success, but could you model your success or explain your model for success with kids who want to emulate you? And it's the cool right thing to do. I mean, your own kids are going to do it. Your friends are going to do it. Your parents might do it. Your parents might do it. Hi, how you doing? Well, mom, dad, I sit in a room and we conjure up the next hype social token. Oh, don't worry, none of these are worth anything. Oh, really, Johnny? Okay, great. Yeah, we're really proud of Johnny today. And Johnny ain't doing no good, right? Johnny ain't doing no good. Versus what we're looking at, right? When we focus on the New York Institute of Finance, when we focused on refined elements of what pro traders look at, we're going to be doing good. If there's the kids in the high school that want to emulate it, we're going to have something to talk about, a kid who's interested. If it's your parents who want to emulate it, we're going to have something dignified to talk about in terms of our participation in the market. If they say, well, I want to do that too. Excellent. You might find that the kids are more interested in what you're doing the more professionally geared that you are. It doesn't have to be pro in such an instance, but it has to respect the norms, the foundations of trading. And the more it does, the more interest you're going to find with maybe your spouse, maybe your friends, maybe the type and quality of group that you're around. Pretty cool stuff, huh? Pretty cool stuff. And it's kind of like why we're all here somehow. So, divergences. What in the world is a divergence? What is going on? I saw some VIP work in those divergences. Work in those divergences. Now, you could load. It may just do this. Here we go. Now, divergence, great example. Great example. Because a divergence is always going to tell you what to do, right? Negative. What is a divergence? Like some of these are perfect, and then some of them just hammer you. Because look, man, I'm going to trade on the hourly. First of all, you have to let a divergence set. A divergence is very important. When do you see a divergence? We've already talked about the bull and bear buying pressure. It's exactly the candle wick in terms of the standard deviation. Okay, relative to the moving average, right? We already got that, right? So what's a divergence? Let me look closely. Okay. The divergence is the following. A divergence is going to exist, and this is one of the more complicated. It is a full throttle divergence system. This is the 158 miles an hour. Okay? We're the guys showing up to the track. The other guy's having to adjust his car to race against us, I promise, on this one, okay? On the example. You're not going to find a more complete divergent system. If you are, it's going to be a bit too much. Now, as we were to look at, we've tested on through maximized out divergences like you have no idea. Now, you would say, well, I like this hidden bullish divergence. It's perfect. I like that. It picked up here. This is not a signal generator. This is showing you the difficulty, pronounced difficulty of using a divergence. Okay, please look at this, because the one thing you're not going to get in a divergence, it's not a bull or bear code. It's just not. You're going to have to balance your divergence with the notion that you just went bullish here. Bulls just took authority, control of the market. What did we have? What did we have in the back? We had a pattern. We had a pattern that we traded. Absolutely. And you had a shift. Bulls took momentum in spite of a hidden bearish divergence. What is the big clincher? As you look at any divergence in the market, what's the big ticket item here? The big ticket item is that when you have a indicator that's functioning properly and the bulls and the bears are literally scheduled into and moving in a proper direction, you won't have a divergence. Did you understand that? When you have a price line conformance and continuity with your indicator, you won't have a divergence. No, every price is going up and the indicator is going up. So there's no divergence. Make sure you understand that. No, there's no need for a divergence. So the hidden bearish divergence here was taken over by the natural operation of the indicator and what it's demonstrating. Literal bullish activity literally just corrected any divergence and it operated as normal. But we don't have the bullish signal other than, let's just say for now, other than the capital line here, the blue, boom. So when an indicator functions as you would rationally expect, you're not going to see a divergence. That's the biggest issue you need to understand if you're using divergences. Oh, so it's going to show you when the indicator is not working potentially correctly in the context of the interplay between price, the chart, and the indications that you're being given. A lot of these are nice moves. But some of them you're going to find is like, wait, well, what happened? There was a bearish divergence. I'll tell you what happened. It either played or the price and the indicator got back in line. Yeah, or it's either going to play like this bearish divergence here. Boom, boom, on the hourly. That was a big one. That was a big one. But then you have a hidden bearish here. What happened? Well, actually, everything got back into line. It just got back into line between the price and the actual indicator. We re-achieved conformance. You're not going to see a big billboard pop up. You are not going to see a big billboard pop up and say, hey, everything's back in line. No, you had a hidden bearish divergence. And what happened? Well, the indicator got back on the same page here as the price. Hey, very simply put. So that's the one danger that you're not going to hear very frequently. As you use a divergence, you're not going to be warned, hey, you're only looking at the problem set here, at the confounding problem set, potential warning flags. Yeah, it's like the all systems go. It just means that it's behaving normally again. Price is moving in the same direction as the indicator. So you're given that warning flare off the bow of the boat, right? And it's like, well, hold on, everything is normal. You're not given that, all right, all systems go. You have to continually remind yourself as you're looking at a system of potential divergence here, at a divergence calculator, that when things are functioning normally, Well, hey, that's what you're looking for. The entire time is for the indicator to operate in line with the norms. Now, why do we have so many divergences on this Z-Pack? Why do we have so many divergences on this Z-Pack? Guys, it is an incredible thing to watch and understand what is going on. Because what's nice is this. What's nice is that we're hitting up into levels of standard deviation and we're continuing to go up, right? And you understand how the standard deviations work. You understand that in terms of standard deviations, we like to hit, we like to pop, we like to create some room and direction for the standard deviations, but you also know that we hit into bam, boom, over the 4 standard deviation. And then what? Sometimes we like to keep going up. Oh, yes, sometimes we like to keep going up. Now, as you are in to a trend, don't buck the trend. Let these be warning shots off a bow of maybe another distant boat or something. It could be a false flag. That could be the guys messing around. That's our co-op branch team out in their boats doing whatnot. Yeah, whatever. It's a PTA club out in their flotilla. Whatever. Flotilla. They fired a warning shot or whatever. Maybe the PTA group, the Rotary Club over there in their buffoon boat. We don't know. But what is happening is you're having a lower expression on a standard deviation basis, okay? Less power is going to the upside, okay? Less power is going to the upside in terms of the initial hit at 4. Now we're only hitting it at 3. Now we're only hitting it at 2, okay? You're seeing a continuum here, not of a necessary reversal, but a weakening of the force with which bulls are pushing up into even that same level of standard deviation. So the continuum, the pendulum swings down. Relevant and increasingly relevant. On different time frames, you're going to find a ton of good trades. You just are. You're going to find a ton of good trades on divergences. But it's not for the faint of heart, and it's not for. I tell you what, you don't want to do is the following. Pay attention. You don't want to exclusively rely on divergences and find that, man, I'm trading like 4 hours a day. I trade every morning. And it's like the divergences pick up in the afternoon, and you're hooked on divergences. This happens to traders. I trade 4 hours every morning. I'm on the 5-minute time frame or the 1-minute time frame. Look at all the ones in the afternoon. Uh-huh. Just imagine the market will do that to you, huh? But you're so throttled into exclusively trading on a divergence that you're not experiencing any of the benefits of the trade, right? The market's continually, that continuum, you're on the wrong time of the continuum. And let's say if that pendulum swings on the validity of and this is great, guys, on the validity of a divergence, let's say it's valid and you have a time differential that's invalid. Let's say they're valid, and then a time continuum, and then they're invalid. You guys got it. It's the morning and the afternoon, and then on into the evening. Hey, we catch a few good ones. And even that is somehow a bit adjusted in terms of the number and volume. And then it's instead of let's say a morning, now they're or the evening, now they're valid in the morning. As you work with the program featuring that's thrown at you, you don't want to get off sync in terms of that continuum. You don't want to be exclusively tied to the usage of divergences and not be able to participate in them, right? I want you guys to be able to participate in the entirety of the market and how it presents the opportunities for you as a trader. So I like the continuum in that if you have a bearish divergence, just understand you can have another one. You can have another one before it's really recognized that let's look at the daily. Let's just look at the daily for a minute. But you could have another one. Here we did well with the bearish ultimate here on down and through. It was a heck of a bearish divergence. But you can see that we oscillated between bull to bear to bull to bear, bull, bear, bull, bear. Okay? And just don't exclusively rely upon them unless you're guys. I mean, unless you're just ready to feel what it's like to continually be on the wrong side of the pendulum. Some people can't emotionally take that. I mean, it's guys. I'm until my fourth or fifth. Let's say divergence or hidden divergence. None of these are hitting. Maybe you need to adjust your uh, your your expectations in terms of divergences, particularly to include the fact that your divergence isn't showing you what your indicator is maybe the best at all the time. It's not going to show you an anomaly. Essentially, it's like we want to point out the anomalies between price anytime things aren't coordinated well. And you're going to see a lot on volatility. It's nice because on volatility, it's like, man, there's a highly volatile coin, highly volatile asset. There's all types of restructuring going on. It's that surprise movement. You see, it's loaded with divergences. It is a divergent kind of characteristic. I mean, we want to seek out and find with a turnkey solution from zero point 0.5 to 1 to 1.5 and a turnkey solution with leverage typically. We want to see if we can dabble in that asset structure which goes from 1 to zero point 0.1 to 1 to 10, right? We want to see if we can capture that 100x level of volatility. Oh, it's all about the divergences. It's all about you see what I'm saying? It's all about in the context of increased volatility, what we're seeking, price action, yeah? Surprise. It's all about that. It's all about, and you would say, because you would look at this and say, there's no way there's that many divergences, but that's what we're in this game for. But when the pendulum is working against you, I just say if you're exclusively relying upon divergences in your trading, you're missing the component that there is going to be a ordinary functioning of and renormalization of the indicator vis-a-vis or in comparison to the price action, the chart. And when that normalization occurs and you're able to trade normally in line with the indicator's expression and function, right? You just say maybe the blue line, the capital line, right? Maybe just the capital line. But if you lose the grasp and you're only looking for differentials or aberrations or these divergences, you're losing the fact that, well, it's not going to show. You're completely off into the forest, right? Head buried in the dirt without realizing that the indicator can operate perfectly in line with the price action. It doesn't have to be diverging every different. No, it's a complete bears in control, bulls in control. So keep that in mind. That pendulum, right? You're only looking for misbehaviors in the pendulum. Sometimes the pendulum swings just perfectly, and that's not going to be included as you were to either show or not show your divergences. Don't buck the trend. If you trade those, trade them with stop losses. Enjoy it. Trade them with stop losses. Enjoy it. Do 100 rounds on them until you really get the get go on it. And it's a point of consideration as you were to look at the entirety of your other indicators, patterns, overall fundamentals, geopolitical, on and through Fed, Powell, etc. Economic data reports. It's a consideration. Okay, we're sitting and hanging out in a bearish divergence. What does that mean? Well, do I pull the trigger? Okay, what we have. Now, we've gone through volatility. We've gone through a bit of the divergences. Think of the continuum, that pendulum. And don't just focus on the negations in the market. It's like I'm going to learn nuclear physics, and I'm only going to focus on the electrons. I'm only going to focus on the negative. Dude, that guy's going to fail. That guy's going to fail. Nuclear physics, he only wants to focus on an electron. It's like, well, look at a proton, man. Look at a neutron. Look at the whole neutron bomb, man. You're only focused on the electron. Come on, dude. Right? That's the electron, okay? The divergence is the electron. You need the proton where it's actually coinciding, and we have that normalization in terms of the function of the indicators working perfectly with the price. that proton, the positivity, right? And then we have the neutron, maybe a correlation or not correlated. If we have a negative correlation, maybe that's the electron, that's the divergence. We have the let's say the ambivalence of a neutron. It is maybe not definable. And then we have that proton where everything is just right in line. Okay, so it takes it's going to take all of that to pass the nuclear trading course. Yeah, not a bad example. So let's get in the back and let's trade. This will be a good reinforcement if you want to rewatch that in terms of what is price doing in a specific time frame. You guys got it. Why is volatility, the operation of standard deviation, below that average, below the average? That's the average, that flat line basis. This is the standard deviation, the range, buyers and sellers below that average. And when we test into and test that specific kernel regression line, our weighted, very refined average here, when we test into it, that's when you see those potential transitions. Okay, that's when you see the potential transitions. And when we're up and over, that's when you see the specific blue, the red, the white, and the blue. So we will continue to trade, and I'm excited about the success in 2023. It's matching up to be quite a little exclusive group thus far. We are working on commercialization. Don't even worry about it. On rooms full of disaster-ridden individuals who want to focus on electrons. Ooh, maybe I don't know. I don't know what they want to build, but disaster-ridden would be what? Ooh, I found something on YouTube. Let's go trade it. Ooh, I found something on guys. I mean, even I have to tell you, disaster ridden. Ooh, I just heard on CNN or CNBC that Bitcoin's going up, all time high. Let's go buy it, son. The disaster ridden could be. We just saw on CNN, Bitcoin's it's at an all time high. What do you think? Shall we buy some? Let's go ahead. Let's go ahead and invest. I feel good about this one. Disaster ridden. All right. Something is at a new all-time high. Ooh, what do you think, kiddos? Shall we buy some? Disaster ridden. Okay. Just it's traded without discretion or plan, right? One thing that we see here. Let's do a parallel line channel, something like this to this. All right. That would be nice. Bit of a function. That would be nice. Okay. In terms of a expectation of the market, if you have to build out a bull flag, even the notion that one is forming below the 200 moving average, fine. Go ahead and do it, Bitcoin. Fine. I know you're all trading. Congratulations on the trade this morning. That was a nice move, wasn't it? Nice move. Good volatility. Hit back into what? Throw back into level of resistance, potential pickup zone. Potential pickup zone on the throwback. Yes, indeed. And get acquainted with the TA. This is London. Great to talk to you all this morning. Hopefully, this will be something that we'll be able to use in the future as we delve into volatility. It'll probably be a set of 1 to 5 videos that are deeply structured, and we'll probably refine the content thereafter to make sure that you understand 110% what you're looking at, what you're trading. Okay, we want you to know and discern the tools that you're using here and be able to, on an equivalent basis, be able to shield yourself from anything that you don't understand in the residual of the markets. Very important. Don't hop shop around to the next solution as you were to look at what's going to provide you real value. It's that racer on the track who's going to understand every part of his car that's going to let him take that next turn at 185 miles an hour or do that all day long without problem. And know the guys that are showing up to the track that don't even know their car. Man, they don't even know their car. We could almost rebuild this one I could watch the rebuild or direct the rebuild of this fine racing machine. You guys got that right. So take care of yourselves. We'll be in the back. This is London. If you're not a member of the number one trade group, most of you are. If not all of you are. And I know that. Make sure that you join today from a desktop computer.